Madam Speaker, ladies and gentlemen, if there's something we ought to have learned from the 2008 financial crisis, is that securitized debt is dangerous and can lead to complete and utter financial ruin. It can lead to ruin for the issuer or the company or financial institution packaging this debt as a security, something that they can sell to the secondary market, probably similar to how the stock market would work. And this can also be particularly harmful to the buyer, meaning hedge funds and other financial institutions and rich people who want to be able to buy that securitized debt. At its core, securitized debt is shit that is covered in gold, and no matter how much you try and pass that off to someone else, it places a lot of risk, ladies and gentlemen. It can even put a lot of ruin and risk to the overall market, the real estate market, the stock market, and the bond market, things which are proximate to the average consumer and average person in the world. Make no mistake, this debate isn't about debt being good or bad in itself, but a very important question we have to ask is, why would a financial institution have to be able to securitize that debt? What this means, and the litany of an info slide basically means that this is a complex financial way of trying to be able to pass that debt off as another product to someone else, like those I mentioned in my pre-oration. The problem here is that separate from other kinds of investments, this specifically is more subject to the volatility of market conditions and boom and bust cycles that can ultimately lower the prices of these things and lead the buyer of that securitized debt with a shitty asset with no liquid market that they're stuck with, and ultimately does not allow the cash flow or revenue generating opportunity from that transaction to happen to the issuer of that particular debt. The reason why people would buy securitized debt to begin with is because they're trying to diversify their portfolio. It's called arbitrage or hedging in the financial world, and they do that because they don't want uncorrelated assets, meaning the stock market goes down, real estate goes down, maybe this kind of thing is just mid. So those are the incentives why people want to do it. But the risk, and in the majority of instances, like what we saw in 2008 and even other past financial crises, is that financial institutions use securitized debt as a way to get liquidity of last resort. Instances where it works presupposes good financial economic conditions, wherein we're a bull market, where things are green, things are good, the economy is fine. But as what we all ought to know, financial markets move in cycles. And in instances where even the most sophisticated investors and rich people with all of the research and all of the information get that wrong, it leads to absolute fucking ruin. What is the counterfactual, as this is a regrets motion? How is our side better absent securitized debt? Number one, corporations and financial institutions are pushed to be able to grow more sustainably and bootstrap their investments while making sure they can actually pay for this expansion. That is to say, they don't borrow willy-nilly and don't get into huge amounts of debt that put a huge amount of distress on their balance sheet and financial statements. This looks like the consulting joke, being able to increase sales and revenue or be able to decrease costs or expenses to make sure that your bottom line is actually profitable. That is to say, in many instances, large financial institutions accumulate a lot of debt because they're trying to be able to grow too fast. We want to be able to change their mind. I'll take you in a while. Number two, the comparative is that there are standard debt refinancing methods, meaning you can renegotiate the terms of your debt, and in instances where you have enough reserves, you can even get more debt. And you might say, Joseph, that's bad. No, it's not. Companies like Nvidia and the Magnificent Seven do it all the time because it presupposes cash flow to be able to pay for that. On the comparative, when you have securitized debt, you pass that off to other consumers and financial institutions. That is way too risky. POI from Wern, go for it, my guy.
Yeah, so assuming you have the set amount of capital in the world, without this securities-backed debt, what incentivizes banks to lend out more money than they have?
So banks can lend out other things, right? Like securitized debt is not the only way to be able to structure it. Debt like the bond market or fixed income instruments like being able to borrow to go to college, being able to credit card, being able to finance a condo, all those things will remain untouched. But the thing is, on the comparative, when securitized debt actually does happen, those very people who take normal debt get absolutely clobbered. Like what we saw happen to the bond market in 2008 and even in past market cycles. Bonds are supposed to be safe. Stock market, cryptocurrency, those things are risky. But even the bond market, ladies and gentlemen, as what we've seen with mortgage-backed securities, when people were trying to securitize this debt because they wanted to be able to buy luxury homes in some shitty part in California, ultimately get cooked. So those very people you want to give access to these instruments get absolutely wrecked. Side opposition might say, how about the Dodd-Frank Act that was able to overhaul regulation? Or what about quantitative easing, which is a fancy way of saying the government's gonna bail you out and pay for those things? The harms of these other alternatives that the world tried to do is that it's simply too much risk, right? The 1% of people who can afford even securitizing debt in the first place, because we're not talking about like the average person, we're talking about robust financial institutions with the capacity to structure it. Heck, even in the developing world, we don't have much securitized debt. This is simply too much risk, ladies and gentlemen. And since then, people haven't done that so much. So on our counterfactual, on our comparative, things are better off without it. On the idea of quantitative easing, this is largely inflationary, like what we've seen during the pandemic. So in instances where you accept or expect the government to bail you out, or you expect them to be able to be the buyer of last resort for all of your securitized debt, is ultimately not just inflationary, but a waste of money in terms of the opportunity cost, and ultimately harmful. Ladies and gentlemen, just because you can do something doesn't mean you should. Some financial instruments, especially the vague, ambiguous, and complicated ones, are too much risk. We are very proud to open this debate and stand on side proposition.